When it comes to calculating country risk exposure in your portfolio, sovereign ratings can become a contradictory measure. We have actually learned that looking at country risk scores or banking system risk scores, it's a best way for you to start looking into that aggregation of credit risk. We have several sovereigns where the underlying ability of the sovereign to repay its debt is particularly strong, but that does not translate in the strength of a banking system risk or the strength of the institutional framework for corporations to do business. When it comes to Cyprus, this is an excellent country to look at this divergence between sovereign ratings and country risk scores or banking system risk. Currently, the sovereign rating stands at CCC following the recent bailout. However, when we actually look at corporate country risk score, that sits at a level of A+. This is a very good indication that the underlying institutional framework for corporations to do business in Cyprus is actually much better than the sovereign rating would indicate. In the case of banks, we also have a difference between the banking system risk score anchor and the actual rating of the sovereign. However, that distance is perhaps a little bit less noticeable than in the case of the corporates.
Another thing that is important to highlight is the accuracy of the BICRAS versus the S&P ratings. So when we looked at the S&P ratings versus the BICRAS scores, we actually found out that 75% of the time, the S&P ratings will be within 2 notches from its BICRAS. When we develop the model, we're going to have different data sets to work with, right? So depending on certain regions, we're going to have better data quality that allows us to achieve higher accuracy. Sometimes you don't have that benefit, but the overall accuracy of the model is 31% exact match, just under 32%, 71% within 1 notch up or down. So that basically tells you that from a model perspective, we are 30% of the time exactly as the S&P rating would assess.
And looking at companies in emerging markets, it can be quite difficult to make a reasonable analysis on how well a particular company is doing. So looking at 3 different factors, including the external market, doing a relative analysis, and then looking up the supply chain can be quite an effective way of assessing creditworthiness. Well, it can be quite useful to understand a specific company's liquidity position, and a quite useful way of doing it is looking at its business relationships, specifically up and down the supply chain at a company's customers and its suppliers. So looking specifically at its customers through our Excel plugin, it's quite easy to find their cash conversion cycles to understand how quickly a company is paying and how quickly a company is collecting.